Hello, welcome to everyone. Good morning for those of you in Europe and good afternoon for those of you in China. So welcome to this webinar. The title is How to Access the Opportunities from Chinese Outward Investment and the Impact on European Small and Medium Companies. The outward foreign direct investment from the Chinese multinational enterprises has been growing noticeably in Europe since the last decade. And this presents a business opportunity for European SMEs. Actually, from 2005 to June of 2013, 98 large Chinese M&A operations were concluded in Europe with a deal value of more than 77 million euros. So today, actually, we have Professor Haiyan, which actually write a report for us. The center report Chinese outward foreign direct investment in the European Union, and we will have him today to give a presentation on this topic. So before we start with the presentation, for those of you who are not very familiar with the platform, with the system, you can see that in the right side in the screen of your computer, you can see a console. You can use that console to interact with us, to ask us questions, and we definitely encourage you to do so, and we will try to reply during the presentation, or at the end we will have a Q&A session. So please ask us any question you might have. And a little bit about the EU SME Centre. We are a project founded by the European Union. Our goal is to help companies, small and medium European companies, to get ready for China. We help them to export into this country and to establish, develop and maintain commercial activities. We do so by providing confidential information and advice, and we also provide some support services. So I will introduce now our speaker today, Professor Haiyan. Actually, Professor Haiyan holds an MA and a PhD in Public Administration and Management from the University of Antwerp in Belgium. He's also an Associate Professor of Asia-China Business Strategy and Management at Neoma Business School, and also the Director of Neoma Confucius Institute for Business in France. He's a visiting professor of different Chinese universities, and he's also teaching in international MBA programs about Asian business environment and strategic management. His research interests include China's inward and outward direct investment, high-tech industrial cluster, internationalization of Chinese and overseas Chinese-owned enterprise, management issues of international joint venture and transition economies, and so on. He has published in journals such as Management International Review and has contributed to around 20 books. He is the co-author of a book about European direct investment in China, published by Routledge in 2002. He has consulted for several trade associations, government institutions, and multinational companies in Europe and China on different topics such as the US direct investment in Belgium, strategic management of bilateral cooperation with Chinese local authorities, mergers, and acquisitions in China. Actually, I have the pleasure to meet Professor Haiyan in the Understanding China program, and he has a very extensive presentation, but he has a lot of knowledge about this topic, so it's really a pleasure and an honor for me to introduce him. With no further ado, I let him get into the topic.
Good morning and good afternoon for everyone. Today I will try to discuss the Chinese investment in Europe from a perspective of global value chain. Then we will discuss about the Chinese global value chain in Europe, and then try to see what's the opportunities and also challenges for European SMEs to link up with the Chinese global value chains.
Okay, but before we start with your presentation, actually I would like to launch a poll, our first polls to the audience. So what we are going to ask is in which sector are you more interested? And we have different possibilities, and these are 5 possibilities. One is leasing and business services, finance, mining, wholesales and retailing, and finally manufacturing. And we will give some time to the audience to vote, and then we will display the results, and Professor Haiyan can comment on it. So last seconds before we close it. And yeah, as you can see, many companies in the manufacturing area and some also in the leasing and business services.
Okay, we will continue with the presentation, and I will try to focus on manufacturing and also trading activities, because most of you are interested to these two particular sectors. So first I would like to give you an overview on the recent development of Chinese outward foreign direct investment. This is a report by MOFCOM, 9 September 2014, so just 1 or 2 weeks ago. They published the annual report on Chinese investment. And from this report you see clearly that the Chinese outward investment flows reached $100 billion by year. So it's a growth of 23% as compared to 2012. This is I would say the old story. So from more than 10 years, Chinese outward investment increase every year by 20 to 30%. So that's why we say it's an old story. But something new, that the importance of China as an outward investor became really impressive. So the position of China in terms of OFDI stock moved up, so from 13 to 11 position over last year. Then, as we already mentioned in the poll, that Chinese investments are highly located or concentrated in 5 sectors. It's leasing and business services, finance, mining, wholesalers and retailing activities, and also manufacturing. These 5 sectors account for 83% of total Chinese OFDI stock in Europe by the end of last year. Another aspect, merger acquisition. So merger acquisition became a very important form of Chinese OFDI in Europe. So if you look at numbers, it's already 53 billion in 2013, meaning that Chinese investment, half of Chinese investment was made through merger acquisition, and the other half is greenfield investment. Then private sector become very important. Some 10 years ago, 80% of Chinese investment was made by state-owned companies. Today, private companies, they accounted for about half, so 45%. This is a huge change, especially this is a result of the development of Chinese economy, which moved from state dominant sector to some kind of a private entrepreneurial oriented sector. Then we see also the contribution of foreign subsidiaries of Chinese companies becoming important. Now in last year, Chinese overseas subsidiaries generate about 1.5 trillion sales, and it was 15% as compared to the year before. The total number of Chinese employment in the world reached 1.9 million, so nearly 2 million people, and about 100,000 are located in developed economy. So this it's also quite good news for Europe and also for developed economy, because Chinese companies contribute to the job creation. Then let's see the big figures, and these show you the inward and outward foreign direct investment flows. It's actually it's investment coming from other countries to China, and Chinese investment going out to other places. So the yellow line actually is investment China received. The black line is Chinese investment to other countries. And the gap between these two lines becomes smaller, meaning one day China will become a net investor. And this is very important. The position of China has changed, slowly changed from a receiver country to an investing country. So before China, in the Chinese FDI policy, China tried to promote foreign direct investment, tried to attract foreign direct investment. And the priority of the Chinese government today is to move to the protection. So how to protect its investment overseas, how to get market access for Chinese companies in other countries. So this is a quite important change which can influence the ongoing negotiation between the European Commission and China for investment agreement. Then the position of China as investors today is already very important. If you look at the figure, China, since last year, since 2012, China became the third most important investors in the world in terms of flows. So the investment made during 1 year. So just after US and Japan. And if you look at numbers, China will catch up US in few years. Actually in 2020, China will surpass US if China and US going with the same speed as today. Then China is still not top investor in the world. Chinese investment represent about 7% of the world total foreign direct investment. But China account for about 20 in the world trade flows, 14% in the GDP. This gives us expectation that the Chinese investment will increase, still increase, and China still have a room to do with the outward investment. Then where they invest, as usual, Asia account for about 70%. Europe is 7%. Europe is the most important destination of Chinese investment as compared to other developed countries. So if you look at the figure, North America, including Canada and the US, they account only for 5%. So what's the key feature of Chinese investment in Europe or in the European Union? There are several new elements. Some are in line with the global trends. So firstly, the privately owned enterprises become very important. So they surpassed the state-owned companies to become the most important players in Chinese merger acquisition in Europe. So today, more and more private companies, they come to Europe, they buy European companies or work together with European companies. Then Chinese companies have emerged in the East and Central Europe to acquire production facilities and strategic assets. There's a reason behind that development. as you know, the labor costs in China become more and more important, and the gap between the labor cost in China and low-cost manufacturing countries in Europe become smaller. So that's why Chinese companies, they come to produce in Europe. On the one side, they have a much easier flexibility in production and in logistic management, and also much closer to their customers. And the most important reason is that they can avoid this kind of anti-dumping measures which have been imposed to the Chinese exporter by the European Commission. Then the third development is merger acquisition has become the most important entry form for Chinese investment in Europe. Then more and more Chinese companies, they try target sectors in which European companies have built up a world-class operational and management expertise, especially in innovation. We'll come to that point later. And we see also more and more rich Chinese individuals, they come to Europe to buy European product or some assets with European cachet, like French wine, vinery, things like this. So that's the new development in Europe. From a figure here, you see Europe became a very important destination of Chinese investment as compared to North America. We suppose that because there were two important events. The first one is in 2005 when Chinese offshore oil company want to buy American company. The project was rejected by U.S. Foreign Direct Investment Commission, which check all investment projects to see if there's a problem with Europe, with America national security or strategic security. So that project was rejected and made a lot of feedback or talk in the Chinese newspaper. And the second one was a takeover of 3Com by Huawei. That was also rejected by the same committee. So that's why Chinese companies, they feel that they can get same product, same technology in Europe, which has no such a measurement, such a measure. So that's why they come to Europe. That's we understand from this kind of movement.
I would like to ask you actually, like I can see from the data, it's clear that there is a new trend and that the data show that the investment in Europe is increasing. But do you think it's going to continue like that in the future?
The recent data actually show that there's a decline of Chinese investment in Europe as compared to other countries from 2012. So last year there was a decrease of about 15% as compared to 2012. So this gives us an impression that Chinese companies to some extent reduce their interest to Europe. There was some explanation on that. First, because the recovery of European economy is quite slow, and the second one is the restructuring process of European industry is also likely impossible or it did not start. So that gives some kind of impact on the Chinese investment in Europe. According to the last report we made about Chinese investment in Europe, the company data or the accounting data show that more than about half of Chinese companies in Europe lose money. So this, I would say, have some negative impact on the Chinese interest to Europe. But from a long-term perspective, I would say Chinese companies, they continue to look for very good technology, small size or medium size companies, and they will continue to buy European companies and to try to extend their value chain in Europe. This will not stop like this, but I think that this negative impact from the European slow European economic recovery.
Thank you, Professor Haiyan.
Then from this figure, I come back to the general trends that the red line is Chinese investment to Europe. The dark line is European investment in China. The European Union's investment actually. And from here you see from 2010, China already became a net investor as compared to European, as compared to investment from European Union. And this will have a strong impact on the ongoing negotiation between China and Europe on investment agreement. This figure you see from 2011 to 2012, there is a decline, and from 2012 to 2013, again, a decline. This is from data, so we would say in short term there's decline, but I don't believe this will continue, this decrease will continue. Then, if you look at this figure, we see that Chinese investment in Europe is still very limited as compared to the foreign direct investment in Europe. China represents only about 2% of total foreign direct investment to Europe, to European 27. That's in terms of flows, and in terms of stock, it's still very limited, only 0.4. So meaning Chinese total investment in Europe represents only 0.4 of total foreign direct investment in European Union. So quite limited. Where they are, so if you look at this figure, you see most merge acquisition projects took place in North Europe and Western Europe, UK, France, Germany, and Denmark, Norway, and Sweden, and etc. So sectors, we know many people are interested to the manufacturing industry. Actually, Chinese investment in Europe, in manufacturing, European manufacturing, is only about, in numbers, it's only about 6% of total Chinese investment in Europe in terms of numbers, but in terms of assets, it's about 21%. So half in high-tech industry, half in low-tech industry. And Chinese investment is highly concentrated in less knowledge-intensive services, that said, mostly in trading activities. But the assets of this sector is very limited. It's about 3%. But Chinese investment in knowledge-intensive services like telecom service, management service, business service, leasing, and also telecoms, financial services, it's very important. It's about 86% of total assets of Chinese investment in Europe.
Yeah, before you continue, actually, I would like to launch another poll, and what we want to ask the audience is about like how are they in contact with these Chinese investors. So we have different answers. So you can say no, nothing, and no, but we are actively looking for investors, and if you have some initial contacts, or if you are already working with a private investor, or you're working with a Chinese multinational. So yeah, we would like to see what's your relation with Chinese investors, so Professor Haya can target better the next part of the presentation. And yeah, we're gonna still give you few more seconds, but we can see in the results here that more than half of the companies have already some relation with investors, and actually some of them are also looking for so yeah, let me close the pool now, and I will share with you the results. Yeah, and you can see 46% have some initial contacts, 10 they are already working with a private investor, and 6% are working with a multinational company. So yeah, we'll hide the results and let Professor Hyan continue.
So we try to. It's possible to take a look at this?
Yes. Yeah.
Yeah. Okay. First we need to understand why Chinese companies come to Europe. So first, if you look at Chinese economy, it's in a crucial moment to switch from export investment lead to consumption driven model, meaning that there's a slowdown in Chinese economy, especially export and inward foreign direct investment. Then there's an increased demand of Western good products, especially the increase of a middle class in China. They want to have good product from Europe. So that's why many Chinese companies, they try to offer products from Europe, at least with good enough quality, and sometimes with luxury brand from Europe. That's we would say Chinese companies come to Europe to look for technology. Actually, this technology will be used at home country in China to upgrade their product. And also they bring European brand to China. For European companies, this is an opportunity for them to actually enter into Chinese market and to get a larger market size through this type of cooperation. Then the other one is Chinese companies used to operate at a low-end market. They do not have this kind of they did not have this kind of competition with European multinational companies. But today the situation has changed. So European companies, in order to get a larger market segment, they come down from a premium market to good enough market. So they try to simplify their technology and produce with a cheaper or lower cost and cover large parts of the Chinese market. And the Chinese companies, over years, they learn from European or Western companies. They upgrade their product. Actually, they upgrade from low-end market to the middle market, and then they meet each other with European companies. They start to compete at the segment of good enough market. So that's why Chinese companies, they are facing competition from European companies. They need to upgrade their technology to learn more from European companies. That's why they come to Europe to look for new technology. Then you see a rise of trade and investment protectionism in Europe and also in US, which also to some extent motivate Chinese companies to come to produce in Europe. That's the case that we talked about Eastern and Central low-cost manufacturing countries. For instance, Poland, we already saw some Chinese big production facilities there in the telecom, in the consumer electronics. And that's why if we look at Chinese investment in Europe from a global value chain perspective, we can easily divide Chinese investment in Europe into 3 stages. We have first knowledge creation stage. The second is operation manufacturing. The third stage is distribution, supporting services. Then from this global value chain perspective, we will try to see how European SMEs can link up with these different stages, can be part of this value chain, can contribute to the Chinese extension of Chinese value chain in Europe, and can benefit from Chinese activities in Europe. Then we first see the creation. Knowledge creation actually it's a very crucial and important competitiveness of European companies. Small or bigger, European companies used to base their competitiveness on the innovation, on the research and development activities. So Chinese companies, as compared to European American companies, when they come to Europe, is not to use their technology advantage as European American companies did in China. So European companies, when they come to China, they bring their advanced technology to exploit their technology in China. By contrast, when Chinese companies come to Europe, they try to get new technology. Actually, it's an exploration of European technology, acquire European technology. So we call that asset seeking. They try to get some key components, key competitiveness in Europe, and they try to learn from Europe. So this is quite different. And they sometimes bring some new business model, especially if you look at low-cost leadership position. Some Chinese companies build a very strong knowledge of the large-scale manufacturing capacity. So that's I said about TCL's production facility in Poland. So they bring a full production lines with high manufacturing technology to produce in Poland. But that's very exceptional cases. In most of the cases, they try to buy European technology. Sometimes people worry about that. They say, okay, Chinese buying our technology, close down our European facilities and bring technology to China, and one day they become our competitors. I would say till now I did not yet see a case in that way that they buy technology, they close. Usually they try to set up a research center on the basis of the facilities they acquired in Europe. So probably you have experience in that way that the Chinese companies set up a research center in Europe on the basis of their acquired firm. At least they extend these kind of facilities. For instance, in the report I wrote, you will see a case about research and development center set up by Shanghai automotive industry. So they invest with a very important amount of budget to create European research center, development center for their global business. So this creates some opportunity to European high-tech companies to work together with them. We already saw that in Italy, in the Milano area, some Italian designer companies, they work together for Chinese car makers, and also universities and also other knowledge partners. For European companies, this is also a possibility to extend the life cycle of their product. So because the European market is small and quite advanced, so now with Chinese companies, they can come into Chinese market, and they have a new market, large size market, which can be can provide some return for them to invest in new innovation activities. Then China represent also sometimes a low cost base for research and development. Some companies, they actually relocate their labor-intensive research activities in China, but keep the core parts in Europe. So we have some examples. I would skip that. You can read in the report. In the operation and manufacturing, I would say Chinese companies try to upgrade from OEM to OBM. Few years ago, Chinese companies produced for European companies under the subcontracting system, the so-called original equipment manufacturing activities. Today, as I said, that Chinese company want to upgrade their name, their brand, their technology. So they come to Europe and to buy their OEM partner. So some years before, they produce for that European company, and today they come to buy that company and to get the brand for themselves. So that we see already some cases. Also, I mentioned that in the case study. So these especially apply for small European companies. So what is the contribution of Chinese companies in such a manufacturing, such a takeover? First, they can increase the manufacturing size because usually European companies is by nature they focus on European market. Today, when Chinese company take over or join these companies, they bring usually a global strategy. So they look Europe as a part of the global picture. So usually they extend the business, the market into North America, especially Asia and China. So there's a switching from European business strategy to global strategy or Asia strategy. This is a very important change from our case study. So I would say this can be quite positive for European companies. But on the other side, if the business, because the branding is much related to the culture, to the European culture. So if the brand became totally dominant in China, then you probably lose your global brand image. That already happened in French wine sector. In Bordeaux area, some gastro, some vineyard became producer only for the Chinese market, and over years I would say they will lose their global image. So we need to pay attention to that. Then the linkage opportunity for European companies, component producers. So if you are supplier for these companies, Chinese companies, you will probably increase your business volume because Chinese producers will have a bigger market size, especially in China. And the logistic companies, we already, from our case study, we already see that Chinese companies try to establish a pan-European logistic network, and in most of cases, small companies, they have been involved in this process. So example is a TCL operation in Poland and Ed Green creation in Belgium. So you will see that in the case study. Then the last part, the third stage, is distribution and supporting service. I would say Chinese companies start to acquire transportation facilities, especially in ports and container terminals, transportation networks, and also we see more and more in the acquisition of distribution channels and after sales service activities. For instance, the Lenovo's acquisition of Medium in Europe. So I will skip this part, and you know they need more and more service on this side, and you have more opportunity. And business service, regarding business service, probably accounting companies and law firms, they will fund more business activity when Chinese company start to invest in Europe. So who are these investors? I will quickly give you an overview. Three types of investors. State-owned companies, they used to work with large European multinationals. So usually you have less opportunity, especially when you have a small size. Chinese state-owned companies, as you know, in China, they have an attitude that they are top companies. They don't like to work with small companies. This tradition of the partnership with small, medium-sized companies in China is quite unfamiliar for them. It's not like in Europe. So you have less opportunity, maybe in the future. Private companies, then you have more opportunities because they used to work with small companies even in China because of their low-cost leadership strategy. So they try to lower cost and they try to work with small companies to lower the overhead cost. Entrepreneurial and family investors, you get more opportunity. You can even become partner when they need local partners. So I will skip this, especially we have time limit, but if you look at this entry form, you see half of Chinese company in Europe is wholly owned subsidiaries. They don't have a partner in their as an investor, but half they actually try to find the local partners in their business to invest together. Then who are their partners? So half from China, 1/4 from the local host country, meaning when Chinese company come to Europe, they find their partners from local business community. So I will skip this. So what's the linkage for European firms? What's the opportunity and the challenge for European SMEs? So to supply components, materials, service, to transfer their existing production product technology, to increase market share, especially when they operate, they produce together with Chinese companies. If they can diversify, they can expand into Chinese market. Then to adapt a new corporate strategy that we discussed already, from European strategy to global strategy, especially from some kind of new approach, especially regarding to the cost reduction. Chinese companies have some cost leadership strategy. What's the challenge? That's very difficult for SMEs to fully understand Chinese company. It's a very complex. In most of the cases, they are not transparent. The corporate governance, the ownership structure is not so clear if you compare to European companies. Management structure is often overlapped with ownership structure, and decision-making process in the state-owned companies as well as in private business is not so clear, highly hierarchy, complex, so that's why it's difficult for European companies to understand. Second, difficult to cooperate with Chinese multinationals, especially because of the pressure, constant pressure from Chinese company to lower costs. They used to operate in a lower cost environment in China. You know how they are strong in bargaining. So in China, they can always find the cheaper service or goods. So they have this attitude to come to Europe to ask for lower cost service or product. Then time compassion in China used to work with companies which react quickly. So over 24 hours, they get everything. But in Europe, they put the same time pressure on European companies. And this also made European companies difficult to get the profitability in their business. Then the most important, I would say, the culture, language barriers, which is actually for both sides to understand each other. So, so what's the recommendation that we can give to European government and to business representatives as EU SME Centre or Chamber of Commerce? So what we say, first we need to increase the awareness of SMEs about the opportunity and the challenge when they link up with Chinese companies, not only opportunity, but especially challenges. We need to prepare Chinese company, European companies, support their business through networks and through business matchmaking activities, information, database, etc. Then, second, these organizations need to support local SMEs along the value chain at different stage to provide better conditions adapt to different stage. So spatial policy for research-oriented investment, spatial policy for large-scale manufacturing activities, and then you can try to help SMEs to connect, especially when they do supplier activities, logistics service, or distribution activities. Adapt to different type of activities. Then should promote Chinese value chain as part of the global or internationalization process of SMEs. Then the last one is organizing training activities for European companies. I stop here because I want to have some Q&A session.
Thank you very much, Professor Haiyan. It's been really interesting. And before we start with the questions, we have quite a few. I would like again to highlight the fact that you have write a report for us. It's a report we're going to publish today. It's going to be available from today in our website. It's called Chinese OFDI, investment in the European Union. And I think it's very interesting, and you mentioned in this report the links between the multinationals and the small, medium companies along the global value chain is being frequently studied in the literature to analyze the opportunities and challenges for small companies in the developing countries cooperation with Western multinationals. But the recent economic globalization, it's changing this, and it's not longer restricted to multinationals from developing countries. So we see multinationals from Brazil, China, India coming into Europe, and you have brought this very interesting report from that perspective. And as you mentioned, also there is some case studies. It's very practical, and definitely we encourage the audience, because we have a very limited time, only 1 hour, but they can get deep into this matter with this report. And yeah, one of the questions we got from few participants, it's a very general, very difficult one, and I will give it straight to you. It's like, what are the good sources to find Chinese investments? How can they make that connection? What are your recommendations?
I would say first and the most important sources is Chinese sources, because Chinese companies used to rely on Chinese embassy, Chinese Chamber of Commerce like CCPIT. They have their rep office in every country, and they got first-hand information. Then you can also go to this specialized Chamber of Commerce like European Chamber of Commerce in China, or in every country you have a special Chamber of Commerce. For instance, in Belgium, you have a Belgian-China Chamber of Commerce. They use to organize different network activities for Chinese and for European companies. I would say they usually get first-hand of information. That's the way you can get. Yes, more and more local governments, they have this type of initiative to invest abroad. So if your city or your country have a particular link with a particular region in China, for instance, this type of sister city relationships, that could be also a very important source and also support from Chinese government for this type of initiative.
Thank you very much. Also, one reflection we did before the webinar, it's about like the use or the need these SMEs companies providing services to Chinese companies of Chinese people in Europe. And this could be like Chinese students abroad, or this could be like a Chinese born in Europe. And we were discussing that this could be a very effective way to reach to these potential investors.
It's a good remark, Javier. I would say this is a very good suggestion. If you want to work with a Chinese company, or if you want to work with China exporting from Europe to China, or work together with Chinese investor in Europe, it is better to have a Chinese-speaking staff, or a student from China who may study in Europe. So someone who has knowledge about Europe and China, that will be valuable stuff for you to reduce this kind of cultural barriers.
Okay, and yeah, one of the questions from Bruno Rudik, he's asking us if the Chinese investors, they only acquire company or technologies with a proven track record, or if they are ready to invest in very new and innovative technology.
I would say both. The first things we saw a few years ago, some private Chinese companies, they did not have enough knowledge about the European companies, and they look at the cheaper sellers. So they bought some bad companies and they lost money. But more and more you see they start to look for good companies, solid companies, and it's no longer about the price, but more about potential. That's why we see Chinese companies start to acquire leading companies in some sectors, chemical sectors, and in Germany it's more in machinery sector, key component producers. They look for really this kind of global niche players which can provide good component, good product for the global market. So that's I would say definitively they move to this stage.
Thank you, Professor Haiyan, and I think we have just time for one last question. But actually, it's a complicated one. But I'd like to know your opinion. It's how do you see the role of Chinese financial investors in Europe?
You know, this was a lot of talk between China and Europe a few years ago, and actually the position of Chinese government also quite mixed. So at the beginning, Chinese government promised to participate in this kind of investment for solve the public debt problems. But the reality, if you look at data, statistics, is that Chinese government, especially the Chinese state-owned holding company, investment company like China Investment Corporation, actually it's so many railroads companies, state-owned investment companies, they start to buy European public utilities and transportation facilities as some kind of financial support to European companies. For instance, in Portugal, in Spain, Chinese companies bought a number of larger public utilities in power generation, in transportation networks. So these are what we can see. It's actually Chinese government try to help some countries through this kind of business investment. I would say not just giving money like public aid. It's actually through a business solution. It's also in the interest for Chinese government because, as we know, China has 4 trillion foreign reserves, and before China invests in U.S. bonds, state bonds, so now Chinese government also try to diversify the foreign reserve and invest in this type of facilities or assets. Yeah.
Well, thank you very much. It has been a pleasure to have you today here at the EU SME Centre. And I just want to finish now and again remember you that we are going to publish today the EU SME Centre report on Chinese of OFDI in the European Union, a work done by the Professor Haiyan, and we hope you find it very interesting. We're also very happy with this report. So thank you very much for having everyone today, and we look forward to seeing in the following activities at the EU SME Centre. Thank you.
Okay, thank you very much.